Economic and financial analyses draw their variable elements from the firm's consolidated financial statements. Here's a model statement to support our example. It has the balance sheet on top and the income statement on the bottom. The takeaway from this slide is the weighted average cost of capital, the benchmark that describes the investment performance of the firm's assets that are already in place. You'll see at the bottom that the weighted average cost of capital depends on two elements: returns to equity, shown here in blue, and the cost of debt, shown in red. If you pause on this slide, you'll see how financial statement line items contribute to the weighted average cost of capital. This slide shows the cash flow results from which we build the ratio of benefits to investment, our definition of value. After the initial $1 million investment, the $250,000 annual energy savings for years 1 through 9 are adjusted first by subtracting a depreciation charge, yielding a taxable income figure. The 35% income tax rate is applied to this, leaving a net after-tax income figure. The after-tax cash flow in its entirety is the benefit that this investment provides. Take a look at year 10, the last year in the economic life of this investment. You'll recall that this asset is depreciated on a 39-year basis, so in year 10, there's still 29 years worth of asset value not yet depreciated. This value is a write-off for tax purposes, so it boosts net income in year 10. The results from the cash flow allow us to calculate a profitability index, or PI. The upper line of the PI ratio is the investment's benefits, the total sum of future after-tax discounted cash flows. The lower line is the sum of total project investments, which in this case occurs entirely upfront at the beginning of the first year of this project's economic life. The total benefits exceed the total investment, so the PI for this proposal is greater than unity. Specifically, the discounted cash flow from this investment not only returns the original $1 million investment, it creates an additional $228,153 by the end of the 10th year. In this slide, we see how discounting affects future returns. Discounting is achieved using the weighted average cost of capital, which for this example is 8.7%. We also see that the PI metric is dynamic over a range of years. The benefits and investment values used to calculate the PI metric is summed cumulatively through each successive year. For example, the PI through year 3 is only 0.4. The PI metric achieves parity when total benefits equal total investment in year 8. After that point, the cash flow provides new value over and above the original $1 million investment. Remember that the returns are adjusted for taxes. Before you decide that this doesn't compare well to the 4-year simple payback, consider what comes next. What happens if the energy-saving investment is refused? That means you've committed to a cash outflow for energy waste. From an investment perspective, an avoidable outflow of cash is capital recovery in reverse. By failing to invest in energy efficiency, the business starts to destroy its own capital reserves. You can develop the corresponding cash outflow. Start with the value of the energy waste. Subtract from that the tax shield because the energy expenditure is still tax deductible. Do this for each year of the economic life of the refused investment, in this case 10 years, and discount this 10-year cash flow using the weighted average cost of capital. You now have an unprofitability index. the inverse of a profitability index, because you're now comparing the negative value of energy waste to a total rejected investment amount. In this case, your benefit is the $1 million investment capital that is retained in lieu of the proposed investment. Unfortunately, the negative discounted cash outflow accumulates to an amount equal to the $1 million investment by year 9. Through the total 10-year economic life of the rejected investment, an additional $56,783 in additional capital is destroyed. That extra value is extracted from retained earnings. Here's the 10-year cash flow that supports the unprofitability metric. Like the PI metric before, this is a dynamic measure that is cumulative with each successive year. What we just did was an economic analysis. We showed an investment's capacity to create value and the velocity of that capital's creation relative to the firm's current rate of capital recovery. We also showed, in the same terms, how to measure the value destroyed by refusing the investment. The next step would be to incorporate the impact of third-party financing, that is, using other people's money. To do that, we measure the internal rate of return on cash flows after financing. We capture the financing impact in this cash flow summary. We start on the left with the after-tax cash flow that we determined earlier from the economic analysis. Next is the financial amortization of the loaned capital, shown in the shaded area. We're interested in the payment amount, which is of course a cash outflow, and the interest portion of the payment, which is tax deductible. The investor's after-tax outlay when using third-party finance starts with an upfront down payment. In this case, it's 20% of the $1 million total investment. In each of the years that follow, an after-tax outlay is the sum of monthly loan payments minus the value of the tax savings on interest. You can then determine the free cash flow. It's the net income minus the tax-adjusted outlay for project finance. The internal rate of return is calculated on the free cash flow. Internal rate of return is also a dynamic measure. It ramps up cumulatively with each additional year's cash flow. The internal rate of return is positive from year 5 in this example and grows continually thereafter through the asset's 10-year economic life. Through 10 years, this project, financed at the given terms, yields a whopping 29% internal rate of return. Now we have annualized measures of relative investment performance. The investor's best non-business alternative is a 2.9% return on mutual funds. The cost of borrowed money is 5%. The firm needs to sustain a 10% overall rate of return to remain competitive in its industry. The proposed energy efficiency investment, when financed for 7 years at a 5% cost of capital, generates a 29% internal rate of return. Accepting this investment would add an asset that improves the firm's overall rate of capital recovery. This cartoon is pretty good at illustrating the business impact of energy waste. Now let's wrap up with a summary of facts. The $1 million energy efficiency investment proposal offered a 4-year payback. According to conventional wisdom, this does not compare well to the 2-year performance criterion. However, as a 10-year investment, this asset returns the original $1 million investment, plus an additional $228,153 in new value. In contrast, the rejection of this proposal destroys the original $1 million plus an additional $56,783 through 10 years. It's useful to know that the terms of financing, 7 years at 5%, yields a free cash flow with an internal rate of return of 29% through 10 years. That compares very well to the 8.7% rate of capital recovery that the firm earns on its existing assets. So what's your conclusion? This is Christopher Russell. Thanks for watching.